Hey, good afternoon, everyone. This is Christine Fontaine with the Florida HFMA chapter. We're going to give it another few minutes to see if any late stragglers are joining us. And then we'll get into the fun conversation. Hope you all had a lot of coffee today on financial accounting concepts. So we'll give it just another minute and then we will get started. Okay. Just a reminder, as we're giving other folks some time to join us, this is being recorded and will be available on the Florida HFMA YouTube channel. So if you want to use this as a basis for, doing your recap and studying after these are all done, then they will be available. The PowerPoints will be available on the Florida HFMA website. So you can take them from there and use that also for some training. If you miss a session, again, they'll all be available there. So I had some folks that weren't on last week, certainly use that as a resource to catch up if, your real job gets in the way of Florida HFMA, which mine does all the time. And so also, as a reminder, taking this course only will not prepare you to pass the CHFP exam. Our recommendation is two things. Sign up for CHP on the HFMA website under certifications. It is free if you are a member of HFMA. Take the course along at the same time. What we're doing it, so as we're going over module 2 today, please either do prior to or right after it to relearn those concepts and reinforce what we're talking about today. Plus, there are significant practices and things like that that you're going to want to go in and reevaluate. So we'll ask that you please. I'll ask that you please go on mute if you're not talking, or Alyssa, if you can mute everybody other than myself right now, that'd be great. And please stay off camera. At the end, we'll unmute everybody. Feel free to ask questions. Questions can be put in the chat if it is, technical in nature, how to sign up for the exam. We'll try to get to those during the course. If not, we'll try to get to any materials questions at the end as well. So let's get started. So managing any business requires a basic understanding of financial management. Accounting is a way of keeping track of the resources to get work done and enables the measurement of financial results of a business's operations. If you know what resources you are using, you can be more effective in controlling them and make your organization more efficient. So this section is going to provide a broad overview of financial accounting. Now, my area of operations has always been revenue cycle. So for me, really understanding financial accounting, and as you'll see throughout multiple courses during this, there are going to be, the ability to calculate formulas. And that's something you're going to want to really make sure you understand. I know I needed to. So the accounting system used in most healthcare organizations, physician offices, hospitals, dental clinics, or health plans is based on a double entry system where there are two sides to every transaction and the two sides must always be equal, or as an accountant says, in balance. As the name implies, double entry bookkeeping means that every financial transaction is recorded in the books of a business twice, and usually at the same time. One entry is made to an asset or a liability account. The other two, an owner's equity account. In some cases, both entries are made to assets accounts, liability accounts, or owner equity accounts. However, in all double booking entries, the amounts recorded must equal each other. So an example would be recording the purchase price for an item and then also an item. So accounting basics. Let's get in here. My apologies. There's a few more transitions than I had expected. I thought I took them out. So I'll walk through that. So balance sheets are permanent accounts because their balances carry forward to each new and successive accounting period and can be broken down into 3 categories: assets, liabilities, and net assets, particularly in a not-for-profit organization, or equity in a for-profit organization. So if you think about your own personal finances as an example, you have things you have and bills you owe, right? So accounting is no different. We break these things into 3 categories. Again, what you have or are owed, known as an asset. Is it an economic resource available for use? What you owe, known as a liability, an economic obligation or debt owed to another person or lender. Think about your mortgage. And then what you get to keep or retain, known as net assets or equity. Think about your the amount you owe, you currently have in your equity in your home. So again, it is the difference between assets and liabilities as in consider the owner's financial interest in the organization or net worth. So the self-balancing nature of the accounting equation is best exemplified by a trial balance. A trial balance is a complete listing of accounts in a general ledger in a left and right arrangement, with the debits on the left and credits on the right. Notice that a trial balance contains not only an entity's balance sheet accounts, think assets, liability, and again, net assets, equity, but its income statement accounts as well. Revenues and expenses, which are temporary because their balances are closed out, to net assets, equity at the end of the accounting period. So since by convention, debits are recorded as positive numbers and credits as negative ones, a trial balance is in balance if the sums of both sides net to 0. I was not a good accountant. This was not something that I was really good at when I tried my hands at that. So it's kudos to those of you that have that. So a trial balance is the unformatted raw material from which financial statements are prepared. The trial balance shows the balances in any general ledger account at any point in time, but usually at an accounting period end, month, quarter, year. So I think we're coming up to our first polling question. Let me get all the answers up there. So you bought a house for $250,000. The terms of the purchase were 20% down, and then you took out a mortgage for the balance. How would this transaction be recorded? So I should get to do math. We'll give you a few extra seconds there. Okay, they'll close that out. Awesome. The correct answer is 3. Good. The cash amount is $50 is used along with a $200,000 debt to purchase an asset worth $250,000. The decrease of cash is offset against the additional asset of $250,000. Thus, the transaction results in a net increase in assets and liabilities of $200,000. Okay. So accounting basis. Another basic element of accounting is the matching principle, which says that when recording transactions, we should match the revenues earned in a given time period, a month, again, quarter, or year, with the expenses incurred to earn that revenue. So if a clinic provided 200 patient exams during the month of January, and those exams resulted in $10,000 in revenue, then the expenses generated during that time, such as salaries, office rent supplies should be recorded in the same month. In some cases, certainly, we may not know the exact amount of revenue to be collected or salaries to be paid at the end of the time frame we are using. In that case, it is allowable to use a reasonable estimate until the true amount is known. In accounting, we call that estimate an accrual. And then the matching principle is the basis for what is known as the accrual basis of accounting. Most corporations are required to use the accrual basis of accounting, and it is specifically required by CMS for financial reporting purposes, such as a hospital, a FQHC, or a health plan annual cost report. So accrual-based accounting is used to ensure the proper matching of revenue and expenses in that accounting period in which the underlying economic transactions take place. Often the revenue for services provided is not realized in cash until subsequent months, and the bill and payment for a supply may not be received nor paid at the current month end, but by necessity in the subsequent month. To help get revenues and expenses matched up in the same and correct accounting periods, entries are recorded to book receivable assets and payables, liabilities, and the related revenues, expenses. And in accounting, again, these entries are called accruals. The other common basis of accounting is the cash basis of accounting. Cash basis accounting is like how many people normally keep their personal checkbook, recording revenue when received and deposited to the bank, and recording expenses when a payment is made. That is not considered a generally accepted accounting principle, also GAAP, primarily because it does not comply with the matching principle. Some physician offices use this method because of its simplicity. The cash basis of accounting would be accepted in a small organization like a physician or dental office. Larger organizations, again, like hospitals, multi-specialty clinics, or health plans would be required to use the accrual basis of accounting. As we mentioned, the accrual basis of accounting is a part of generally accepted accounting principles defined by the American Institute of Certified Public Accountants. The accrual basis of accounting is also requirements of the Financial Accounting Standard Boards, the Government Accounting Standard Boards, and are all sets of rules and guidelines similar to those set up by the Joint Commission and CMS. So again, we have another concept slide we're going to review here. Practice had the following transactions during the past year: provided and billed for $800,000 worth of services, collected $750,000, incurred $750,000 in operating expenses, and paid $725 in expenses. Using the cash accounting principle, because this is now a practice, calculate the, can't read the last line there, Alyssa. Because that slide's in the way. Let's close that out because I think I might have missed a little word there when I was updating this. What we're looking at is the correct answer is actually $25,000 per HFMA. Since the clinic uses the cash basis of accounting, it calculates profits using the actual cash collected during the year minus cash payments during the year. And I'll get that. That's the actual profit. My apology, I couldn't see that in the slide as we move through that. So moving on to the next. Okay, key financial statements that we want to make sure that we review. The basic principles of accounting described in the previous sections are used to prepare the 3 financial statements used in the financial management of business, including a healthcare organization. So the statements that we're going to review are the statement of financial position, commonly called the balance sheet, the statement of activities, commonly known as the income statement or statement of operations, and then the statement of cash flows. So as we mentioned, the balance sheet, also known as the statement of financial position, describes the organization's assets, liabilities, and net assets at a specified point in time, usually the end of the accounting period, again, month, quarter, or year. This definition applies to a physician clinic, hospital, health plan, or other healthcare organization. This financial statement is based on the accounting entity I described earlier. Again, assets is equal liabilities plus net assets. So here are the key points to remember regarding the balance sheet. It reports an entity's financial position at a point in time, what is owned and what is owed. It must be in balance. Debits must equal credits. It is based on the accounting entity. And again, it includes assets, liabilities, and net assets or equity. So the statement of activities, or the income statement, summarizes revenue, expenses, and operating income for an organization in a specified period of time, month, quarter, or year. The statement of activities, or income statements, as it is also again called, is generally organized the same way, regardless of the type of entity it relates to. And you could see an example of the basic format of that statement. So hospitals and physicians may serve patients who are unwilling to pay whatever is due, and those amounts are referred to as bad debt. Some healthcare providers, primarily hospitals, will provide care to persons without health insurance or the means to pay for care. This is known as charity care. In financial statements for external use, charity care is reduced from gross revenue and not separately identified on the statement of operations. It is reported in a note to the financial statements. Many will consider bad debt and charity as the same thing, a foregone payment to someone who cannot pay, although this view is not correct. The difference between bad debt and charity is that bad debt, the patient has the ability to pay, but does not, while with charity care, the patient does not have the ability to pay. Identifying that, particularly for our not-for-profit organizations, is critical to ensure that you meet your 501(r) compliance, IRS 990 reporting, and certainly supporting your community benefit to keep your not-for-profit status. So accounting standards did narrow the definition of bad debt expense effective for most hospitals after December 15th, 2018. So it's a little complicated. It's a little bit too much to go through during this session that we have. So please review the online course for more detail on the correct calculation of this moving forward. Again, as we don't have time to review in detail today. An important concept to remember. And we do have another key slide. A statement of activities, income statements includes the characteristics. Check below. There will be multiple. Choose one of them at this point and we'll review all of them. But this is an exact example of what HFMA has as a question out there. So I thought it was important, even though I think our polling questions only allow one answer at a time, I believe. Answer it and we'll go through all the correct questions. Okay, let's close that down in the interest of time. The correct answers are 1, 3, and 4. So it actually covers a specified time frame. The format of the statement is revenue minus expenses minus operating income. That's what it says. And it tracks cash flow from operating activities. Okay. 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 So the statement of cash flows is a financial statement used to determine the sources and use of cash for a healthcare entity using the accrual basis of accounting. This statement literally breaks down the change in the cash balance for an entity from the beginning of an accounting period to the end of that period. The statement of cash flows generally looks the same for a physician clinic, a hospital, or a health plan, and breaks the sources and use of cashes into these three broad categories: cash flow from operating activities, cash flow from investing activities, and cash flows from financing activities. Right. It is important to note that the income statement and balance sheet have a very close interrelationship. Most significant is the relationship between receivables on the balance sheet and revenues on the income statement. For the most part, a healthcare provider provides services on a given day, but then waits for payment on an average period of 40 to 60 days. I hope for many of you, it's a lot faster than that. The generation of revenue does not result in a significant amount of cash at the time of service. Instead, the revenue is recorded on the income statement when it is earned, and a receivable is recorded on the balance sheet at the same time. However, it is important to note that just because a service has been provided and revenue earned, there may be a lag in time before the cash will be collected for that service. That lag is reflected in the amount of receivables on the balance sheet. Managers in any healthcare entity should recognize that transactions that are shown on the income statement might also have an impact on the balance sheet. Essentially, any timing difference between recording of an income statement item and it's finally being paid or collected in some future period is captured on the balance sheet. So again, we have another concept slide to bring these things home. ABC Clinic provided $250,000 in services last month. How would this be recorded in financial statements for the clinic? Let's close that up. We can move on. The correct answer is 3. The clinic providing services generates revenue. So $250,000 would be recorded as an increase in revenue and an increase in receivables. Good job. Okay. Moving on to the next slide. Oops, sorry. 2 very important sources, use of cash for a healthcare business, come from the management of payables and receivables. When the entity has an increase in receivables from one period to the next, that change represents a use of cash. This is because the amount owed for services but not yet collected has increased, and the entity does not have the cash available to spend. Because the organization has not collected what it is owed, it has foregone the use of cash in the current accounting period. Thus, the cash that could have been collected and used to increase the entity's cash balance remained in receivables. Increases in receivables, therefore, represent a use of cash and would be shown as a negative number or a value in parentheses on the statement of cash flows. Oh, another concept slide. Which of the formulas listed below results in net income on a statement of activities? Hopefully you can all read that. I won't read it out to you. Okay, I'm gonna close that up, Melissa, please. Correct answer is number 1. Net income is all revenue minus all expenses. So again, no, what I want to make sure is everybody understands the types of questions that you're going to get as we go through that. I think the expectation is not necessarily that everybody would get it right. For me, I think the important thing, just getting through here. Oops, sorry. Back one slide. Is understanding what will be asked, particularly on some samples of what questions might be on the CHFP. So gaining a good understanding of the results described in financial statements often requires an understanding of what happened during the period covered by a financial statement. Usually the what happened is described using an operational metrics. Operational metrics are simple ratios that describe the volume of services provided to patients, our members, or the resources used to provide services. Common operational metrics will vary by type of healthcare entity and typically relate to the volume of services used or the volume of resources used to provide services. Hospitals use 2 common metrics based on the utilization of capacity: average length of stay and occupancy percentages, and certainly things like volume of services performed on an outpatient basis. Right. Ratio analysis is used in business to assist managers in understanding the relationships between elements in the financial statements. They are also useful in comparing an organization's performance with others. Ratios are also commonly used by lenders to assess the creditworthiness, big word, of a business. A ratio is a mathematical formula, certainly with a numerator and a denominator. So the things that we're going to be looking at is liquidity. It measures the ability of an entity to pay its current obligations as they come due. We know in certainly hospitals, days cash on hand, or probably any organization, is a critical component to look at, and also things like neck days and accounts receivable. Then we also look at capital structure, also known as solvency. And that measures how the assets for an entity are financed, as well as its ability to pay its long-term debt. And so certainly things like debt to equity is calculated by the organization. And then profitability measures the extent to which the entity is generating a surplus. For those of us that have worked in hospitals, we know that operating margin is one that we absolutely focus on, and sometimes can be razor thin, depending on what's going on in the industry or within the organization. So days cash on hand, again, is an important one, gives an indication of how many days of operating expenses the entity could pay with the cash it currently has on hand, assuming no other cash was collected. Cash operating expenses are the operating expenses on the entity's financial statements minus non-cash expenses, primarily depreciation expense. The amount is divided by the number of days in the period to which the operating expenses relate, again, usually a quarter or a year. Another name for the denominator is average daily cash operating expenses. Net AR, which all of us lived and breathed by if you're in accounts receivable or revenue cycle, or even anywhere in the finance operation. Net AR is the net carrying value of patients' receivables on the balance sheet. It is net of credit balances. It allows for the reserves for explicit and implicit price concessions, and that there's more on that in the online course. Anticipated discounts for charity care, and reserves for contractual allowances. The days in payable ratio helps managers in health plans and larger physician clinics or hospital entities in judging how long and on average it takes to pay outstanding short-term obligations. There are two common capital structure ratios: debt to equity ratio and debt service coverage ratio. These ratios assist financial statement users in determining how leveraged an entity is, how much debt it carries relative to its equity or net assets, and how likely it can service its debt. Thinking on real life structure, when you try to go get a mortgage, they're going to be looking at your debt to equity ratio to see if that's a good idea or not to give you a mortgage. So watching those bills as well. So the debt to equity ratio determines where the majority of financing for assets comes from in an entity. The ratio is calculated using the following formula. If the debt to equity ratio is calculated at less than 1, that indicates the entity has most of its assets financed by equity. If the ratio amount is greater than 1, then the entity has financed its assets predominantly through debt. The debt service coverage ratio, I told you you need to have a lot of coffee for this one, is an estimate of an entity's ability to meet its debt repayment obligations. This ratio is calculated with the following formula. A declining value for this ratio can indicate that an organization is in danger of failing to pay its obligations when due. Profitability ratios measure the ability of an entity to generate sufficient funding to pay operating expenses and to have profits sufficient to fund any needed future investments in and the growth of the organization. 3 examples of a profitability ratio are operating margin, medical loss, and administrative load. The operating margin is the single most important indicator of a healthcare entity's financial performance, whether a physician practice, a hospital, or a health plan. This ratio is expressed as a percentage and is calculated by using the formula on the slide. Health plan performance can also be measured using the medical loss ratio, or what they call the administrative load ratio. The 2 ratios are inversely related and total to 100%. The medical loss ratio describes how much of the health plan's premium revenues were spent on medical claims and is an indicator of how the plan is managing these costs. The MLR is expressed again as a percentage and is calculated using the documented formula. So the administrative load ratio indicates how much of the premiums collected by the health plan, again, are spent on plan administration, such as expenses for salaries for health plan staff, customer service, claims processing and payment, marketing, enrollment, and additionally profits for the plan. Clearly, that's what they're trying to do. Again, this ratio is usually expressed as a percentage and is calculated with the formula listed. Administrative costs for health plans under the ACA are expected to remain below 20%, and that is inclusive of any plan profits. Another key concept slide here. I build these in so I can actually take a sip of water. So polling question. Which of the types of ratios listed is part of a ratio analysis? Okay, we'll close that out so we can move on. The correct answer is the number 1. These ratios are among the set of ratios used for financial analysis. Okay. Moving on to the next slide. All right. So talking about management reporting. Management reporting, as we can imagine, assists managers in getting information to understand the financial position, financial condition, and operating results of an entity. There are many such tools available, including interim financial statements. For internal users and also for some external users, such as banks and bondholders, annual financial statements may not be frequent enough for managing the business or assessing performance. Most entities, therefore, also prepare unaudited interim financial statements on a monthly or quarterly basis. Department operating statements allows managers of a portion of an entity, think say radiology, to manage resources better. Dashboards certainly provide a summary of key performance indicators, and they usually select KPIs that influence the entity's financial results and are usually such items such as visit or utilization statistics, important financial ratios, or patient satisfaction results. And we all know we need ad hoc reporting, right? So we know questions come up and we have to get an ad hoc reporting that's going to answer what operationally may be going on. So again, each of these tools can be available and are commonly used in physician offices, hospitals, and health plans. So the general ledger can provide managers with details on the items making up each line of a financial statement, including any accruals or estimates included in that line of the statement. As labor costs are certainly a significant portion of the operating expense for a provider, the labor distribution provides details on the payments made for employee labor costs. Next to labor costs, supplies are a significant part of the income expense for a physician office or hospital. Payments made to vendors are detailed on the accounts payable distribution. The accounts receivable aging, sometimes referred to by terms such as the ATB or age trial balance, provides details on the unpaid accounts owing by payers or patients to the clinic or hospital. And then certainly the audit trail can provide valuable details on transactions entered into a financial system and can be analyzed for answers to many questions not identifiable with the other reports reviewed in this course. All right, we're going to go through one more. What describes what happens in a defined time period? Ratio analysis, management reporting, operational metrics, general ledger. And let's close that out. Unfortunately, somehow I don't have my notes here. Let me see if I can go back to the previous slide. I had my, 1 second. Give me 1 second, sorry. Technical difficulties over here on my side. Yes, somehow I didn't put the answer in my notes. My apologies for that. This is definitely not my best day going on so far. I will get you the answer to that. You probably all guessed right. I don't want to tell you something honestly, I don't know it off the top of my head. So while there may be some controversy around the notion, healthcare is a business. A physician office, hospital, or health plan must generate a profit to continue to operate over the long term. This is true even in a not-for-profit entity such as a hospital or community health center. So finance tracks the expenses associated with the resources used in patient care. So good managers are not required to be experts in finance, but must have an understanding of what information is in financial reports, how management decisions can impact financial results, and how to identify sources of information to improve their control over financial results. So by taking the module 2, or course 2 within the module, you should be able to identify the basic elements of the accounting function, differentiate between key financial statements and be familiar with that information they provide, and then determine an organization's financial condition with the use of financial statements and tools. Okay, and with that, the prepared material has been completed. My apologies, guys, for the technical difficulties in the slideshow today. Hopefully you got something from it. It wasn't too distracting. And I guess we can, I don't know if there are any questions in the chat.
I did have one question come through. Do the formulas need to be memorized for the exam, or is there a cheat sheet with the formulas provided to have on hand for the exam?
No, the formulas won't be in the exam. They're going to ask you to calculate certain things, or they're going to ask you to determine what is that a representation of. When I took the exam, you didn't have a cheat sheet back then. Now, again, question did come up last week about will this be virtually proctored? It is not. You will be asked to sign an attestation by HFMA when you go to take the exam, so you can read through that as well. There is an expectation of you're doing this appropriately, and even if you did have some materials there with you, and I think that's okay, but there's no way you're going to get through the exam by trying to constantly refer back to notes, etc. Now, when I took it again, it was proctored in person, and there was absolutely no use of any type of documentation at all. Okay. Hopefully that answers your question. You'll never be able to have materials to the right of the side while you're trying to take the exam. I would recommend studying them. When you go through the online course, you'll see that there are a lot of questions and practice material and calculations that obviously we couldn't do through today, but there are a lot of examples and things that you can go through that will help you reinforce each formula that I think if you continue to do those and do that right before the exam, you'll be able to get it. Okay. Other questions? Certainly feel free to come off mute if you have a question that's top of mind. Okay, with that, I'm going to presume that we don't. And so hopefully, again, you all got something through this. Hopefully you'll now go out and take that second chapter within the CHFP online course, reinforce that. Certainly, if you have questions, feel free to bring them back up next week, and I will get you the answer to that last question. We'll have that sent out to the organization. So thank you all for your time. Don't forget, if you have folks that are looking to take CRCR, we're doing that on Tuesdays. CHFP is on Thursdays. So feel free to share with your peers as needed. So thank you for your time, guys, and we'll talk to you next week.